Hello, I'm Mike Swanson. I'm the founder of WallStreetWindow.com. I'm glad you're here, and I'm glad you're interested in learning about sector rotation strategies because they're really a key component to success in the financial markets. So let's get right to it. In this video, we're going to talk about stock market sector rotation strategies. It's about how to get an edge in trading and investing in the financial markets. And without an edge, you're kind of lost at sea. The thing about it is, most mutual funds and individual investors, they actually fail to outperform the market averages in any given year. The most common benchmark professional money managers have used to gauge their performance is the S&P 500. If they beat the performance of the S&P 500 in any given year, they consider that a victory. If they lag, it's not so good. Let me quote from you something that appeared in USA Today this past March. There's an article about how most fund managers can't match the S&P 500 results, much less beat it. It said, to quote, last year, for example, when the Standard & Poor's 500 stock index posted a paltry total return of 1.4%, with dividends included, 66% of actively managed large company stock funds posted smaller returns than the index, according to the latest SPIVA U.S. scorecard released Wednesday by S&P 500 Dow Jones Indices. Now, that USA Today article was referring to the stock market in 2015 when it only went up 1.4%. That's what the S&P 500 went up. So that means a lot of mutual funds were flat or even down that year. And the brutal reality is that when it comes to individual investors, their performance in the financial markets actually tends to be even worse. A study done by a college professor named Terrence Odian back in the 1990s shows this. What Odian did was he looked at the brokerage accounts of several million investors with Ameritrade accounts that were actively trading those accounts. They weren't buying and holding and doing no trades. They were doing active trades, changes every month, every couple months. And what he found through a study of, what these guys' performance figures were that half of them were down. They were losing money, even in years in which the stock market was up, and only about a quarter of them were able to beat the market. So about a fourth of them were matching the results of averages, and only a quarter of them were beating the averages, while half of them were losing money even in up years. You need to have an edge. Investing in trading is a competition. It's not easy to beat the market. In fact, I've just told you how hard it is to beat the market. When 66% of the professionals managing mutual funds can't do it, it's unrealistic to think you can just open up a brokerage account, throw money at trades, and win. And the stats that half of people lose, even in up years, demonstrate that reality. You need to have an edge. The good news is that the competition's terrible. If half the people are losing money, you got to beat those half the people, more or less. And they're not thinking that they need an edge. They just are treating this as if they're in a casino. Well, that's not what you're going to do. You're going to face what's going on. You really have two choices right now, two realistic choices. Let's get real about trading and investing. All right. You can recognize that this is a difficult game for most people, and you can tell yourself, all right, I'm just going to buy the S&P 500 and get the results it gets and forget about trying to beat the market, Just throw my money into a fund that mimics S&P 500. You can do that easily by buying SPY. That's an exchange-traded fund that just simply holds all the stocks of the S&P 500 and is created to match the performance of the S&P 500. In exchange traded funds, they are instruments that you can buy and sell at any moment of the trading day. And they, generally speaking, have lower fees than mutual funds do. Mutual funds usually have higher fees, and the managers running these mutual funds, they're buying the stocks themselves or trying to beat the market. Most of them fail. So the simplest thing you can do is just, boom, put your money in the SPY and get the results the S&P 500 gets. You do that, then you're going to make money when the market goes up. And when the market doesn't go up much, you won't make much money. And when the market falls, you're going to lose money. You're going to do what the market does. Some people are fine with that. But if you want to do more, if you want to try to not lose money when the market falls, or make more money when the market goes up, or make money regardless, then you're going to need a strategy designed to do that. And I'm just going to repeat one last time that randomly buying stocks or exchange traded funds because you got hot tips, you see it on TV or in a magazine, or you just feel like it, that's likely going to generate the losing trades that fail to beat the market averages, because that's what these people who are not doing well in the market are doing. That's the competition that you don't want to be a part of. You don't want to be in that group. So what do? Well, you probably guessed it, and it's probably why you bought this video. The only way to beat the market is to be in sectors that outperform the market. Pretty simple. But, it's a concept people may, know in their mind, but if they try to apply it, or really taking it seriously. Well, let's think about right now in this moment. As I'm doing this video, it is December the 11th, 2016. The S&P 500 is up 10.5% year to date. Apple is up 8.2% year to date. That means Apple is lagging the S&P 500. And I bring Apple up because it's been one of the most popular stocks to own over the past couple years. You could say it's been the most popular stock to own. I follow something called the Ameritrade Index. Ameritrade puts it out, and it shows you what are the top bought stocks in any given month. And Apple has been on that list very often over the past couple of years. And, I run my website, WallStreetWindow.com. I get emails all the time from people over the years. Apple has been one of the emails, or one of the things that people ask me the most about. Apple's a popular stock. But suppose on January the 1st, 2016, you would have put every penny you had in an online trading account into Apple. Because in years past, there were times where Apple went up tremendously and beat the market. Well, if you would have done that, you'd be lagging the market year to date. You'd be in a bad situation you don't want to be in. Other stocks have done even worse, of course. Disney, for example, which was one of the top most popular stocks last year, well, it's down this year, 1/3% year to date so far. Other stocks down even more. Biogen, which was a red hot stock in 2014 and for part of 2015. Well, this year it's down 6.1% year to date. But other things are up more than the S&P 500. Gold stocks, for example, have been on a tear this year. Even though they've had a recent drop over the past couple months, even with that drop, GDX, which is a exchange traded fund, which owns a basket of gold stocks, it's up 50.65% year to date. That means if you would have put all your money in GDX on January the 1st, you'd be beating the market. You'd be crushing the S&P 500 performance and crushing just about every single mutual fund manager on the planet and every single hedge fund manager on the planet too. Now, I don't advocate putting all your money into one exchange traded fund, much less one single stock, but it's the concept. And look at semiconductor stocks. They've done well this year too. SMH was an exchange traded fund that owns a basket of semiconductor stocks. Well, it's up 35% year to date. The SMH ETF is also tearing to shreds most people's performance in their brokerage accounts and what most mutual fund managers have done this year. Same goes with bank stocks. The XLF ETF, which owns a basket of the biggest banks in the United States, it's up 22.7% year to date. Again, I don't advocate putting all your money into one single stock or even one single exchange traded fund. But what I like to do is own a basket of exchange traded funds. And if someone would have put a third of their money in GDX, a third of their money in SMH, a third of their money in XLF on January the 1st this year, right now they'd be sitting very pretty. Now, the thing about what I've been talking about is, yeah, I just talked about what's been happening in 2016. Good chance you'll be watching this video in 2017 or 2018 or 2019. Who knows when you'll be watching this video. The thing is that the principles in this video are universal for any year in the market. Now, I've written a book called Strategic Stock Trading. It came out a couple years ago. It's when I released it. That book is primarily about how to pick out stocks. I look at the best single chart pattern I've ever found for buying a stock for the lowest amount of risk and the highest expected reward. I also talk in that book about using fundamental metrics to look for stocks that are priced at a low valuation level but have high earnings growth ahead of them. I have a small section in that book that does touch on sector rotation strategies and the importance of being in the right sectors. But that information is, about the sectors is just a speck compared to what's in this video. Now, the important thing is that I mentioned the sectors in this book, the importance of it. Now, another book that's a much bigger seller than the one I wrote, that you may actually own yourself because it's one of the most popular investing and trading books, period, is How to Make Money in Stocks, written by William O'Neill. He is the founder of Investors Business Daily. That's a newspaper dedicated to the stock market, and we'll talk about it in a few more minutes, but it has hundreds of thousands, if not a million, subscribers to it. But that book he lays out a system in that book for buying stocks. He also looks at chart patterns. He's got a little bit different gauge of the fundamentals he likes to look at. So what he advocates is a little bit different than what's in my book. But what's important is that despite this book being page after page after page after page about how to make money in stocks, as the title of the book says, it also admits and reveals that sector rotation strategies are the true key to even picking out stocks. And he's just got a tiny section about this in the book, despite that fact. But it's very, very, very important. Let me quote from you page 323 from the 2009 edition, which I'm got reading from. And keep in mind, these are universal principles, and the first edition of this book came out in 1998. But the important quote that you need to hear right now is this: the majority of the leading stocks are usually in leading industries. Studies show that 37% of a stock's price movement is directly tied to the performance of the industry group the stock is in. Another 12% is due to strength in its overall sector. Therefore, roughly half of a stock's move is driven by the strength of its respective group. Because specific industry groups lead each market cycle, you can see how worthwhile it is to consider a stock's industry before making a purchase. Okay, end of quote. But let's translate this. What he's saying, if you take 30%, he's, okay, first of all, let's define what does he mean by sector and industry. He says a sector is a broad grouping of companies and industries. These include, for example, basic industries or cyclicals, consumer goods and services, transportation, finance, and high technology. So consumer goods is a sector. Transportation stocks is a sector. Finance is a sector. And then he says an industry group is a smaller grouping of companies within a sector. So let's say finance is a sector. Well, you may have international banks, you may have regional banks, you may have stock brokerage houses. All are, the way he puts it, industry groups within a sector. Myself and the reports I put out, my thinking processes, I just use the word sector for industry group. But if you combine both of his phrases together, what he's basically saying, if you say 30% of a stock's price movement is directly tied to the performance of an industry group, add the 12% due to overall sector, you're now coming up to 50% of a stock's move is driven by the strength of its respective group. So what that means is you can look at an individual stock's price pattern, you can look at the fundamentals of an individual stock, or the story of an individual stock, or the management team of an individual stock. All these specific, unique characteristics of a company, of a stock, and so forth. And the studies done by William O'Neill and his team at Investors Business Daily have shown that all those unique characteristics are only a fraction of what actually makes a stock move. And in the end, half of the price movement is all because of the sector or industry group, as they put it, that the stock is in. That's how critical sector rotation strategies are to beating the market. If you want to pick out a stock and you're not factoring in what the sector the stock is in is doing, it's going to be very difficult to pick out a winning stock. And the fact of the matter is, very few people are doing this. Very few people. And that's the edge you can have in the financial markets. And I'm going to show you how to do this in this video. It's so simple when you think of it this way. Only buy stocks that are in the top sectors. If someone has a hot tip, say, what sector is that stock in? Or say, ask them, is the sector that stock in performing better than the market? If they don't know the answer to that question, they don't have a good tip. But a word of warning. Chasing can be dangerous. If you've seen like those sectors I named before, right? Semiconductors, gold stocks, banks, all outperforming the market this year. Yes, everything being equal, I'd rather own a stock in one of those sectors than biotech or own Apple at this moment. However, simply chasing something because it's gone up more than the market can be dangerous. So it's easy to get caught up in tops doing that too. So there can be a danger factor to misapplying a concept. You've got to apply it correctly. And I got a rule about this. You can call it the Swanson rule. Only buy when you got a good entry point. And only buy in a sector that is likely to continue to be a top sector. How do you do that? Well, that's a secret sauce that you're going to see in this video as we go into it. You're going to see a way to safely identify the right buy points with measured risk. And it's a wonderful thing when it comes together. Just remember, Instead of chasing, the goal is identify future leading sectors. Not simply the sectors doing the best now. And you'll see how to do this. But first, we've got to start with the basics until we get to that step that I think can really give you an edge in the markets, because it's given me an edge over the years. But the basics are simple. What you need to do is you need to know how to know what sectors are performing the best and which are the worst. Before you do anything, you got to know which sectors are the best and which are the worst. It's the first step. You got the concept. You got to find out now how to get the information, and then how to use the information. Those are the 3 steps we're going to talk about in this video, and then you're going to be set to go. The easiest way to get sector data is from Investors Business Daily. This is a daily newspaper that you can subscribe to and get delivered every single day. I would suggest that this is a good way to start out if you're new to the stock market and trading. On page B2 of this newspaper, or I should say section B, page 2, it has a table that divides the stock market up into 197 industry groups. And it ranks all the groups by performance for the past 6 months. So the number one group in this list is obviously the best performing industry group, period. The one at the bottom is the worst. And then it also provides rankings of the past 3 weeks and then the past 6 weeks. So you can get an idea of what sectors are starting to perform better on the short-term basis and on the 6-month basis. Now, they recommend only buying stocks that are in one of the top 20 groups in their book. And I would suggest, if you're new, again, buy the book. Buy my book, Strategic Stock Trading, and buy their book, How to Make Money in Stocks, and subscribe to Investors Business Daily. If you subscribe to this newspaper, you'll be able to look at this industry group data, get a feel for the market. You read the articles. You also get a feel for what's going on. They do a really good job talking about the technical condition of the market and charts and how to use charts. And they have educational columns. And if you read the book and then read the newspaper, it's really a great way to really learn about how the financial markets are moving and really understand what's going on. I really think this is the best way for someone who's starting out or wants to learn more than they do to begin. And it's, subscribing to a newspaper is fairly cheap. Now myself, I've got Okay, what you're looking at here is a screenshot of TC2000.com, the website. And yes, TC2000 is the name of the software that I use just about every single day to look through stocks, to look through exchange traded funds, and to look at the sectors and see how they're performing with one another. Now, it costs me about $29.99 a month to use this software. However, the same company that makes it available also has a website called freestockcharts.com that has somewhat of a version of this with not all the functions available on it, but it's not exactly the same, but it's similar. It gives you a taste of what the Pay TC2000 is capable of. Now, here's a screenshot of TC2000 in action. Now, what you see is a chart of an industry group. Now, Investors Business Daily had its industry groups. TC2000 has its own, but it's got 241 of them. Some of them are bigger than other industry groups. For example, the oil industry groups has lots of stocks in it. When compared with something like toy and hobby shops. Now, the thing is, one of the reasons I like this software is it enables me to quickly look through hundreds of stocks and even all the sectors if I want to by simply clicking the space bar, because it enables you to divide up segments of the financial markets into what it calls watch lists. In this screenshot right here, where you see Morningstar Industry Groups, that's the name of the sectors that it has them all in this one little window, so I can go through them really quickly. I'm not going to do that in this video, but in the members premium area of my website, I do occasional videos in which I go through TC2000 and show people exactly what I'm looking at that moment when it comes to the markets and when it comes to the sectors, and really go into TC2000 in depth from an educational standpoint. I'm not really doing that in this video. I just want you to see that this is the software I use and how it does rank things up into sectors, similar to Investors Business Daily, which does it in a newspaper and it's on its website. But I prefer using this at this period of time in my life. However, for someone who just wants to start out and wants to, get started by reading a newspaper, I would highly suggest that you get Investors Business Daily. So let's do a quick recap and think about what we've been talking about so far. What we know now is we understand the importance of being in the right sectors in order to outperform the market averages. And not only that, but how to even pick out stocks, because half of the gain in a stock comes from what the sector the stock is in is doing. That's how critical it is. And now you've seen the tools that I use and you can use to monitor the sectors and how they're performing. But we got to do more. We got to start to put these concepts together. And to do that, the big question is, okay, now I know how to get the data. How do I use it? So what's the best way to identify future leading sectors with a tool, with a new tool I'm going to show you? So we know how to see what's leading now, but what's going to lead tomorrow? Of course, there's no way to exactly predict the future. There's no guarantee that past results are going to create future results of the same magnitude. There's no way to guarantee anything in the financial markets. But we deal with probabilities, and there's a couple concepts and a tool you can use to put those probabilities in your favor to have the best chance to identify the future leading stocks and the future leading sectors that you possibly can. And the first thing you got to get is the tool of relative strength analysis. It's a very simple concept. It's a ratio. It's created by dividing the price of one ticker symbol by the price of another ticker symbol. So, for example, you can divide the ticker symbol, the price of a ticker symbol such as Apple, with the price of the S&P 500 through the ETF SPY, and that'll create a ratio. Right here on this chart, you're looking at GDX, the gold stock ETF, and below is a ratio created by taking the price of GDX and dividing it by the price of the S&P 500. Now, that simple number drawn out at once doesn't mean anything. But if you plot that ratio out day by day by day, and even week by week, then you'll see that ratio move and trend in itself. And what it reveals is how the first ticker symbol is performing relative to the second ticker symbol. In other words, it enables you to gauge by comparison how a sector or a stock is performing against the stock market itself. And that's what we're doing in this chart by looking at the GDX divided by SPX ratio. That ratio is plotted in the bottom window of this chart. And I've drawn blue trend lines on the chart. What they reveal is that that ratio is going down clearly from the beginning of this chart until the beginning of 2016. What that meant was that during that time period, GDX, which is the gold stock ETF, was lagging the S&P 500. There are times in which the S&P 500 went up and GDX either didn't go up as much as the S&P 500 or actually declined. In times when the S&P 500 dropped and GDX fell more. But then something happened. That relative strength ratio began to go up in the beginning of 2016. And it took a sharp rise. And in fact, the ratio itself basically doubled in price or in number. And had a strong uptrend. And during that time, the GDX Gold Stock ETF, it went from below $13 to over $31. That's a magnificent gain during a short period of time. GDX was vastly outperforming the S&P 500, the Dow, in just about every single sector of the entire stock market. Actually, I think it was outperforming all of them. That's how great it was. And yes, I owned GDX during that period, and it was fun. And I'm still involved in it as we're doing this video. But regardless, GDX entered a correction after going up so much, and during that correction, it underperformed the stock market. However, that underperformance is likely to change going forward from now at some point. And as we're doing this video, I got my eye on that, but you might be watching this video months from now, so that may not matter. That's why the updates I do to the members section is, you know, what you need to be paying attention to if you want to also get my help in applying these concepts to what's going on every single week in real time at this moment. But this concept of relative strength is critical for knowing how to identify what's likely to be a leading sector. And I'm going to show you that in a few moments. Let's look at another stock to understand, or another example to understand how this works. Here's Apple. Apple, as I said before, one of the most loved stocks to own. But something sad has happened with Apple for 2 years. It's been lagging the S&P 500, and this has been easily apparent by simply looking at the relative strength ratio. The ratio that takes the price of Apple, divides it by the price of the S&P 500, and we plot that out over time on this chart on the bottom part of it. And you can see it's been in a slight downtrend, not a dramatic one, not an awful one, but it has been a downtrend. And that has meant that Apple has been an inferior stock to own. It's a stock that if you own it, you can say to yourself, this stock's not going to help me beat the market. In the past times it has, but not for the past 2 years. And there's no real sign that that's about to change, at least over the next couple weeks. So Apple's like a losing position. It's a sad position. It's not a good one. You want to be in stocks and exchange-traded funds that outperform the market or have a good chance to become ones outperforming the market. So what you're looking at now is BBH, the Biotech Exchange Traded Fund. And I've circled on here the fall of 2014. And I want you to keep that time period in mind. Remember, the fall of 2014. We're going to return to it in a few moments, but take a look at what this has done. Biotech was one of the greatest sectors to own from 2012, as you can see on this chart, until the summer 2015. You can see the relative strength ratio in the bottom of this chart, BBH divided by SPX, S&P 500. A wonderful uptrend during that time. However, since the summer of 2015, it's been in a downtrend. In fact, the downtrend is at this moment could even get worse. You can see that it may the price plot on here may actually make a new low on the relative strength ratio. That would be a sign that the selling could actually accelerate. That underperformance of BBH compared to the stock market may get worse. And when it gets worse, that's when you can often get sharp drops in something or big warning sign of trouble ahead. However, how do you enter these things? And that's why I've circled the period on the chart. Now you look at this here, it doesn't mean anything, but it will in a few moments, and it's going to mean something incredible for you when it does. Think about this. Market pullbacks provide opportunities. The best time to buy stocks or buy sectors or buy into exchange traded funds is when the stock market dips. If you buy when the market goes up for weeks and months on end, the longer the market goes up, the greater the chances are that you're buying into a top or you're buying right before a correction is coming. That's just the way it is. Let me repeat that because it's such an important concept. If you see the stock market go up, and it goes up week after week, month after month, and you say to yourself, I got to buy into that. Well, if the market hasn't had any pullback during all that time, the longer it goes on, the more likely a pullback's going to happen. The only way to avoid that danger is to buy when the market has a correction, and the bigger the correction or even a bear market, the better the buying opportunity is going to be when that drops over. It's just the fact. However, something even better happens. Pullbacks give you information because the future leaders of the stock market, when it comes to sectors, they tend to hold up on stock market pullbacks. Let me repeat that again because it's magic. When the stock market pulls back, there will be sectors that fall worse than the stock market does. So right now, as I'm doing this video, biotech is lagging the market. It's lagging the S&P 500. If the S&P 500 was to fall 10% in a correction, and 10% corrections, they happen just about every single year, even in bull markets. If such a correction were to occur now, biotech most likely would fall much more than 10%. In fact, the underperformance is so bad, biotech this year has been actually one of the absolute worst sectors to own. It could even crash. That's how alarming the underperformance is with it. But when corrections happen, the sectors that don't fall as much as the stock market, and sometimes there's even some that will go up a little bit when the stock market falls, they tend to come out of the correction as stock market leaders, and often as new leaders. Why? Why does that happen? It's very simple. There's buying and selling that goes on all the time in the stock market, not just among individual investors, but among corporate CEOs and insiders, their family members, people that know them, people who kind of got a feel for what's going on, insiders, basically. But also smart people that really know a sector, hands-on. They may work in the industry and know when there's growth coming in that industry or slowdowns coming. They just got more knowledge than someone that's turning on CNBC and sitting on their sofa and hearing about Apple. That's just the way it is. The guy watching TV or even the guy reading the Wall Street Journal just doesn't know as much as someone on the ground knows. Look, I trade gold stocks quite frequently. As we do this video, I own them. It may not be the case when you're watching it, but it is right now. I do look at the stocks, the charts, I can read stories, I can look at the financials and this and that, but there's no way I know as much about the gold industry as someone that's working at Newmont Mining does, or someone that's only job is to study that industry. And those people in the know with the real knowledge, they tend to buy when they see opportunities, and the best opportunities come when there's a stock market pullback in an industry that's at a significant bullish turning point in which the earnings are about to accelerate, or the companies come out of an economic trough and so forth. And when that happens, you get accumulation in stocks and sectors during market pullbacks. Well, we may not have the smarts or the knowledge to take advantage of those things and be an insider, but we can see their activities by analyzing the stock market and seeing what the sectors do when the stock market pulls back. Because when the stock market pulls back and a sector holds up during the pullback, that's an indication that something is going on, something significant. It could be insider buying, it could be people in the know buying, but something huge is happening, and that's the type of activity that can lead to explosive market gains for a sector or the stocks in that sector, when that sector becomes a future stock market leader. And yes, as I said before, nothing is guaranteed to work 100% of the time, but this is a game of probabilities, and this is the best probable situation I know of when it comes to the financial markets. This is the best way I know of to buy stocks, to buy ETFs, to buy into the best sectors, period. So, recall that fall of 2014 when I mentioned the biotech sector? During that time period, there was a sharp pullback in the entire stock market from about September the 1st to October the 15th, 2014. You can see it in this chart. The S&P 500 fell from 2,000 down to 1,800. I'm going to get out a calculator and tell you that that was a pullback of essentially 10%. And biotech held up relative to other sectors in the stock market and the stock market itself. That meant there was a great buy point right there for biotech. And you can see in the chart that biotech then went from $90 on the BBH ETF to about $140 in the next couple months. And during that time, the stock market was actually fairly choppy and in a difficult situation to navigate. But biotech was a huge leader. It had been a leader before then, so it didn't become a future leader. And we'll get to how to spot future leaders in more detail. But it was a continued leader on that rally. In fact, it was one of the top leading sectors on that rally. So you can see how if you wait for a pullback in the stock market, 10% is the typical one. So yes, sometimes they're worse. There's usually warning signs that precede a bigger pullback. That's a topic for another time. But the pullbacks provide the opportunities to analyze the sectors and target strategic buy points. So let's look at that time period from September, actually the 1st, 2014 to October the 15th, 2015. Actually, I got the slide wrong here. I mean to look at September the 1st, 2014 through October the 15th, 2014. And then I looked at the performance through the end of 2015. What happened? Well, the top performing sector on that 2014 fall pullback was actually long distance carriers. There isn't really an ETF for that. It's really only a couple stocks dominated by AT&T, ticker symbol T. Over the next 12 months, it was actually kind of flat, AT&T. Drugs sector was the second top performing sector. And biotechs are part of that, and both went up, with the biotechs becoming red hot through the next year. Toy stores, only a couple stocks, so difficult to buy. Utilities, they did okay. But tobacco had a great entry point. Tobacco did great after that October pullback. Restaurants also became red hot after a period of time after holding up during that pullback. Convenience stores were another sector that held up during that pullback. Afterwards, some convenience stores, such as Walmart, lagged the stock market, but other convenience stores, and most of them as a whole, did fairly well over the next 12 months. Regional banks were another sector that were among the top during that pullback. They didn't fall as much as the stock market did. And they're relatively flat for the next 12 months, but in 2016, they've come alive like it's absolutely incredible. So what does this mean? None of these sectors were disasters. None of them crashed. None of them became big market laggards after that fall pullback. Some of them were simply on fire. Not all of them were on fire. So you do need to differentiate a little bit, and you're going to see ways to do that through the rest of this video. But let's look at December 31st, 2015 through February the 16th, 2016. In other words, New Year's, the first 6 weeks of this year. Doing this video in 2016. 2014 may seem like ancient history. 2016 may be more in your brain, especially if you're watching this video in 2016. But there was a significant pullback in the stock market the first 6 weeks of this year. What happened? Here are the sectors that did the best during those 6 weeks, ranked by performance. Gold at the top, silver at the top, security stocks next, trucking stocks next, utility stocks next, department stores once again next, tobacco once again next. So these are the ones to be looking at during that pullback for buys. Notice tech isn't on the list. Why? The Facebooks, the Googles, the Amazons, the semiconductor stocks, and biotech all fell sharply, all fell worse than the stock market. Biotech was actually lagging into that correction. So although biotech was a great buy in the fall of 2014, biotech was not a great buy this year on that correction. And this sector analysis would have told you that. We were looking at this type of stuff in my Power Investor members area, the premium members area. But we targeted gold and silver stocks. But let's think about these sectors, what's going on with them. Here, there isn't a sector for security companies. There's only a handful of stocks, that's why. But this is the main one. It's BCO, Brinks. And you can see what happened. Brinks actually, it fell in January, but it held up as the market was declining in February some more. And it's done great. It's gone from $26 to $44, obviously beating the performance of the S&P 500, which, as I did this video, is like up 9.5% or so year to date. This obviously went up almost 100% from the low of January. Too bad there wasn't a security ETF, but instead of an ETF, someone could have bought a basket of the stocks, right? Or just picked out the best stocks inside the sector. Don't always have to play ETFs. What about the transportation stocks? That was on the list, remember that? The trucking industry. Well, here's the Dow Jones Transportation Average. You can see that during part of the decline, it started to hold up. Look at the relative strength plot. Yes, there was a sharp drop in January, but all of a sudden, while the stock market continued lower, the transportation average stopped falling. And the relative strength ratio was going flat sideways during a period of time of approximately 3 weeks in which the stock market was continuing to act weak and most stuff was continuing to drop. The transportation stocks were forming an incredible base. And they turned up, and they've gone up tremendously ever since, making all new time highs. Among the best things to have owned in the stock market. And as I'm doing this video, I actually own the transportation average through an exchange traded fund, a symbol ILX, I think it is, or ILY is the symbol actually. And here's the utility average. Remember, we looked at the utility stocks came up on the list. They were number 5. Well, you can see the utility average didn't even drop during that January decline. And what happened? The utility average became one of the best performing places to invest in the stock market too, with the relative strength ratio soaring up until the summer. It's traded a little weaker since then. It may not be a great place to remain in the stock market, but it was a wonderful place for 6 months. And tobacco stocks. There's not a tobacco stock ETF that I know of, because there's only a handful of tobacco stocks, but the most important tobacco stock is Altria. Used to be known as Philip Morris, symbol MO. And it didn't pull back at all, basically, in that decline in the stock market of about 10%. And that was a good entry point for it because it's gone up since then even more. It's like the biotechs were in the fall of 2014, though. Altria had been outperforming the stock market for years. So that pullback simply presented an entry point within what had been a long trend of outperforming the market. What the pullback did was give Altria and the tobacco stocks a chance to reconfirm themselves that they were leadership groups. When you have a current leadership group continue to be a leadership group during a stock market pullback, it indicates that it's likely to remain one and remain a great place to be invested. But obviously, even though Altria went up, and that's nice, gold stocks went up more than Altria. And it would be nice to not only apply relative strength investing concepts to be in the best performing sectors, but to also be in the sectors that not only the best performing sectors, let's say 10 of the sectors, but try to pick out the really top of the top sectors, not just the best performing sectors, but the best of the best performing sectors, as gold stocks became after the decline in January and February. And there's ways to do that, and that's what we're going to talk about next. Okay, what we want to do now is focus on profitable chart patterns and combine that with the sector analysis we've been doing. When it comes to investing, when it comes to trading, we choose what to focus on. It's our choice. And that's a great option you have. There are so many things you can do in the financial markets. You can do short-term trading patterns and look for them. You can do that and go minute by minute day trading and try to compete with what are essentially trading robots. But as a general rule of thumb, the longer the time period you look at when it comes to stock market patterns and technical analysis, the more reliable the patterns are, and the bigger the payoff is in the long run. And so what I choose to do is use long-term patterns as much as I possibly can, because I find that leads to more money making in the long run, less risk, and it's just easier to do. So let me show you what the long-term patterns I look at are. I break up any market or exchange-traded fund into 4 long-term trends. Call them stages. Stage 1 is a sideways trend. Stage 2 is a bull market trend. It can last for years. And in fact, most cyclical bull markets in the United States stock market, and in other markets too for that matter, they typically last 3 to 5 years. Stage 3 top comes afterwards, and that can last, usually it lasts a couple months, but it can last for over a year also. And then you have a stage 4 bear market decline, and then the cycle repeats itself. Now, what I also use with the charts that I look at are the long-term 150-day moving averages. They're plotted out on most charts that you use, no matter what the software program is. One of the websites I frequently use for charts, and there are most of the charts you're seeing in this video, is stockcharts.com. If you type in a ticker symbol on that website, it usually puts up both of these moving averages automatically. The important thing is that these moving averages tend to go up during a stage 2 bull market and act as price support. In other words, the price will hit that moving average, bottom, continue higher. In stage 3 top, the moving average tends to flatten out. And in stage 4, it acts as powerful resistance. It trends down. It moves at a downward angle over time, and the prices remain below it. So that pattern in itself makes it easy to identify what stage you're in and know what's going on in the long-term trend in a market. And you know if you're in a stage 1 market that's come after a bear market, that you're eventually going to get a stage 2 bull market. These stages lead to one another inevitably. That's the way market cycles work. Let me show you an example looking at the S&P 500 back from 1997. Now, I've got in blue on this chart the 200-day moving average. You can see how it acted as a price support level from the 90s to year 2000, and then it went into a bear market from 2000 2003, a bull market from 2003 to 2007, a vicious bear market in 2008, and as I'm doing this video, the moving averages continue to act as support in what has been one of the longest stage 2 bull markets in history. Now, the stage 3 I haven't put on this chart. I just want to show you the difference between bull and bear. The simplest thing to identify. Stage 3 can be very tricky. There's other indicators that often act in a stage 3. You're basically trying to identify a bear market top, but prices can continue higher during that time. It's really another topic for more in-depth discussion. But stage 1 is also a basing phase. Typically the moving average descent stops during that stage 1 period, and the moving average actually will start to form a bottom, and that's when you kind of can tell, oh, I'm in stage 1 now. And that's really what I want to focus on for the sake of discussion, is if you combine the stage analysis with what we've been talking about with the sectors, then what you should do is say, okay, let's watch the S&P 500, wait for a pullback. Pullback comes, right? Now you look to see what sectors are holding up the best. You can also go beyond just the U.S. stock market and look at global markets, look at other asset classes such as bonds, such as commodities, such as gold, and so forth. And you say to yourself, okay, what's holding up during the decline the best? Whether that decline's been going on for a couple of weeks or a couple of months or whatever the case. And then you look at the chart patterns there and see, are there any long-term patterns in which we're looking at a stage 1 that's holding up and looks like it could end and go into a stage 2 while it's holding up relative to the stock market? That's the magic combination. That's the combo that I find to be the most profitable to identify in the financial markets, pretty much period, to look for long-term investment points in a sector. Because when you come out of a stage 2 that follows a stage 1, you can get massive gains. In fact, the biggest gains come during that part of a bull market, unless you have a blow-off top to end it, which doesn't always happen. But you almost always get fast, huge gains at the beginning of a bull market. Think of March 2009, what the stock market did. So you can see in this chart, the S&P went from below 700 to above 900 in just the space of a couple months. Now, look at gold. stocks, GDX, because this is an example of what I'm talking about here. The gold stocks formed a base from the summer of 2015 to January of 2016 after having been in a horrible bear market since 2011. That's like a over 4-year bear market. From a historical standpoint, I mean, most bear markets don't last that long. So when you get a bear market that's gone on for that long, when it comes to an end, you can pretty much expect massive gains to come in a short period of time when you come out of stage one. And that's exactly what happened with GDX. And as we pointed out several times, GDX, the gold stock ETF, has been one of the top performing sectors of the stock market for most of 2016. And what I want to point out to you is, remember, in January and the first few weeks of February 2016, the stock market was going through a correction. And if you ranked the sectors by relative strength, as I showed you earlier, during that time period, gold stocks and silver stocks came up on the top. Now, you look at the chart. Here, you can see the relative strength plot trending up of GDX divided by SPX during that time period after having been in a big decline. And you also see the stage one chart pattern. So all these things lined up together in a magic moment and for an awesome buy. And we were able to ride that rally up in GDX this year in the Power Investor Service. I personally own GDX and a couple gold stocks and gold itself and silver and so forth. So in the Power Investor Service, I monitor all this on a weekly basis, looking for these type of opportunities. Typically, they do come once or twice a year. You usually do get a 10% drop in the stock market at least once a year. In bear markets, yes, they cause losses for the market averages, but opportunities to invest do come in sectors like this, and typically there is a new bull market somewhere every single year, even when the stock market itself goes into a bear market. In the year 2000, in March and April, as the stock market rolled over into a new bear market, tobacco stocks, utility stocks, and REITs displayed the same exact chart pattern I'm showing you of GDX right here during those months, and started new bull markets that lasted through that entire stock market bear market. So money could have still been made in bullish sectors during that time period. And in the fall of 2007, as the stock market was rolling over, there was strength in gold and in gold stocks and in bonds. That, the bond strength lasted, for well over a year and a half. The gold stocks did fall with the crash of 2008, but they still were a good place to be until then. So there were changes that had to be made and so forth. But the thing is, you've always got to be watching what's going on and doing these sort of studies to find them. But now you know what to look for. If you want to get started learning more, I would suggest getting my book, Strategic Stock Trading. I show more examples of this long-term pattern and also more applications to individual stocks themselves. So get the book, and I'd also suggest subscribing to two things. One, Investor's Business Daily if you're starting and learning, because if you read that every day, it doesn't take that long. It's not a real lengthy newspaper. You'll get a feel for things too. And then get my Power Investor reports. I put them out every single week and share what I'm seeing and looking at, just as I'm doing in this video, and sometimes do video updates too. So thank you for watching this video and learning from this video, and I'm excited to be able to do it with you and share these things with you and help you learn, and hopefully you'll continue on this journey with me, because that's what it is. You're always learning something new and looking for new opportunities in the financial markets. So till next time, have a good day.